Microsoft is firing thousands of employees. Again, and the stock is down 17% in a single month. But here is the part nobody is telling you. This is not a company in trouble. This is a company making a calculated bet that could reshape the entire tech sector. The question is, are you positioned for what comes next? Welcome back to AI Assets, your daily source for AI investment intelligence. Today, we are breaking down Microsoft's latest layoff wave, what it means for the market right now, and the hidden opportunity most investors are completely missing. Let's get into it. Microsoft is preparing another major round of layoffs, expected to hit thousands of employees across multiple divisions. According to Times of India, the cuts are expected to be announced within days, and the timing is no coincidence. July 1st marks the start of Microsoft's new fiscal year. This is the moment the company resets its priorities, reallocates budgets, and signals to Wall Street exactly where it is headed. The divisions in the firing line include sales, consulting, and Xbox. The gaming division's leader, Asha Sharma, recently sent an unusually direct internal memo outlining 5 hard realities the division must confront. When a division chief writes a memo like that, layoffs are not a rumor. They are a formality. Now let's talk about what this actually means for you as an investor. Microsoft stock has dropped 17% in the past month. On the surface, that looks like bad news. But zoom out and you see something very different. Every single time Microsoft has executed a large-scale restructuring, the stock has recovered and pushed to new highs within 12 to 18 months. We saw it in 2023. We saw it in 2024. The pattern is consistent. The capital freed up from these layoffs does not disappear. It gets redirected into Azure AI infrastructure, into Copilot development, into GPU clusters and data centers. Microsoft has already committed to spending over $80 billion on AI infrastructure in 2026 alone. These layoffs are not a sign of weakness. They are fuel for the next growth cycle. The sectors most directly impacted are cloud computing, enterprise AI software, and AI-enabled productivity tools. Companies like Nvidia, which supplies the chips powering Microsoft's data centers, could see indirect upside as Microsoft accelerates its infrastructure build-out. ServiceNow and Salesforce, which compete directly with Microsoft's Copilot suite, are also stocks to watch closely. Here is the angle that almost nobody in financial media is discussing. Microsoft is not just cutting costs. It is systematically eliminating roles that AI can now perform. Sales support, consulting workflows, back-office operations. These are exactly the job categories where large language models and AI agents have made the biggest productivity gains in the past 18 months. What looks like a restructuring is actually a live demonstration of AI replacing white-collar labor at scale inside one of the world's most valuable companies. This is the proof of concept that every enterprise CFO in the world is watching. If Microsoft can cut thousands of knowledge workers and maintain or improve output, every Fortune 500 company has a roadmap to follow. That is not just a Microsoft story. That is a structural shift in how the entire economy operates, and it is happening right now. The downstream effect is a massive expansion in enterprise AI software spending. Companies that sell the tools enabling this shift, Microsoft itself, Palantir, C3.ai, UiPath, stand to benefit enormously. So what happens next, and how do you position smart? Watch Microsoft's fiscal Q1 earnings call in late October. That is when management will quantify the financial impact of these cuts and give forward guidance on AI capital allocation. Any upward revision to Azure AI revenue growth will be a strong buy signal. Also watch the July 7th date very closely, not just for Microsoft, but for the broader Nasdaq. That is the day SpaceX joins the Nasdaq 100, which will force billions in passive fund inflows across the entire index. A rising tide on July the 7th could lift Microsoft along with it, creating a short-term entry window before the earnings catalyst in October. For positioning, Microsoft at current levels down 17%, with a clear AI acceleration roadmap and a history of post-restructuring recoveries, is one of the more asymmetric setups in large-cap tech right now. This is not financial advice, but it is a setup worth watching very closely. The bottom line is this: Microsoft is not shrinking, it is transforming. And the companies that understand the difference between a company cutting costs and a company cutting to accelerate, those are the investors who win the next cycle. If you want to stay ahead of moves like this before they happen, subscribe to AI Assets right now. We publish daily analysis on the AI stocks and market events that matter most to your portfolio. And drop a comment below. Do you think Microsoft's AI bet will pay off, or is the market right to be skeptical? I read every single comment, and I want to know what you think.